that, just so you know. Okay, we are actually live. Hey guys, give me a minute. I'm trying to pull it up on my, there we are. I'm going to share it on my personal page. If it will let me. Hopefully I won't be blurry today. All right, done it. Okay. Hey everybody, I am so excited. I'm always excited. Leslie Bennett here, coming at you on the Kisker Show, keeping it simple, keeping it real. And today I am with the famous Dave Tallman. He is with Mortgage Solutions of Georgia. And more importantly, he is the lender that I often go to. Thus, the go-to guy. He's one of the go-to guys. They call themselves the go-to guys. So, Dave, did I miss anything in my introduction?
No, I think you nailed it.
All right. And he works with Christian Bland, and we send a lot of folks to them. And well, how many years have you been in the business? Because I know that you're an authority on all these loans.
Yeah, I mean, me and Chris are quickly approaching 20 years in the business. He's got about a year in advance on me, so he's an old man. But yeah, we're both about 20 years in now, so we are definitely industry veterans.
Yeah, so lots of experience. So I guess we're just gonna jump right in because you know, here we go, first of the year, it starts revving up. We are gearing up for our spring season, right?
Yep.
Calls are coming in, interest rates are dropping. It's like hallelujah, we're getting ready.
Yep.
And then COVID-19 hits, right? And so tell us what has changed, Dave, in the mortgage market really in the last couple of months.
Yeah, well, a lot has changed, Leslie, and homebuyers need to be aware of the current market environment that we're in due to the pandemic. So this is kind of the mortgage industry is kind of a complex machine. And so I'm going to try my best to kind of explain to you in layman's terms kind of some of the changes that have occurred. First and foremost, I mean, interest rates are still great. And if you have good credit scores, you're not going to have a problem buying. And on top of that, you're going to get a super low interest rate. But what we have seen change due to the pandemic is minimum credit score requirements. So probably 30 days ago, you could get, you know, an FHA loan or a USDA loan with a minimum score of 600. Today, those are more like 660 to even as high as 680. Wow. I've even seen a lot of lenders completely stop accepting government loans like FHA and USDA and VA. They've just completely stopped altogether. So what's going on with that? Well, the answer to that's kind of complex and it's multifaceted as well. So understand that when a loan is made, that loan is oftentimes sold to a servicer, okay? Because banks are not that well capitalized where they can retain all of the loans that they make. Right. So the bulk of those loans, 70 to 80, maybe upwards of 90% of those are actually sold to a servicer who then collects mortgage payments and pays the taxes and insurance.
Right.
But what happens is that when a mortgage payment is missed, okay, the servicer still has to make that mortgage payment for the borrower, okay? So what's happening in the market now is due to the pandemic, you have a lot of people off work and a lot of people are going to start missing mortgage payments. And if the servicer is on the hook for those missing mortgage payments, then they're about to experience millions of dollars of losses. So the result of that is that the servicers are now saying, hey guys, I know that I normally buy all these loans from you to get these loans off of your books so that you can go then make more loans. Right. But we're expecting unemployment to be 25, 30%. And that's going to result in a lot of missed mortgage payments. And we're going to really lose a lot of money. So instead of buying this group of 2,500 loans, we're not going to buy them from you. You're just going to have to hold on to them, right?
Wow.
Well, that creates a capacity problem in the lending business because as a bank, if I make a $300,000 loan on this hand, then on the other hand, I've got to have $300,000 in liquid assets available to offset that liability. But banks are just not that well capitalized. Hence the reason they sell a lot of the servicing so that they can create liquidity and keep lending.
Okay, so to stop you, just make sure I understand what you're saying. So you're saying if the bank does accept this loan, and then if Wells Fargo or whoever it is that would normally pick up that loan, if they won't pick it up, then the bank is holding it in-house.
The bank's holding it in-house, and that creates a liquidity problem because in order for them to hold that asset, they have to have liquid assets on the other side. So what you started to see happening, banks make their most money on mortgage lending, okay? So a lot of banks, they do credit cards and car loans and boat loans and any other kind of loan that you can think of. Well, what we see is a lot of banks now are curtailing that so that they can free up liquidity in their markets, so they'll be able to retain the servicing on a lot of these loans that they're making. However, because now they're going to be holding a lot of this paper, that's an immense risk for them. And so that's why you see the increased credit score requirements, because banks are saying, hey, if I can't sell these loans to a servicer, if I have to hold these loans myself, I want to make sure that the people I'm loaning money to, they're not going to default on their mortgage, that they have stable income, that they have stable assets, and a higher credit score kind of filters a lot of that out.
So they're calling everyone and just really making sure that the people that are getting a loan can pay.
Yes.
So how does that affect y'all, Dave? Do y'all have other banks that you can go to? If a bank that you normally go to says, hey, I'm not taking anymore right now.
Yeah. So I'm seeing these changes industry-wide, right? And so there's not a lot of, like I said, I mean, some lenders have even stopped accepting new loans altogether until we get through this. There are other lenders out there, they might go to 680. Some of them go to 660. Some of them go all the way down to 620, but those are few and far between right now. And the lenders that are going down that low credit score wise, who knows how long that they're actually going to be able to do that and sustain that. That may be, 7 to 10 days, and they may increase their credit score requirements as well. So, bottom line is right now, a lot of the things that the federal government is doing as well is not helping either. And I think we're going to talk about this here in a minute, but I'll just jump right to it. The forbearance issue, part of the stimulus package is basically forcing lenders to allow anybody to just file for forbearance. And what a forbearance is it basically means, hey, if you got a mortgage payment due for the month of April, but you can't make it, don't worry about it. Just call us and file for forbearance, and then we'll rule that payment, or we'll make it due at a later time. Well, just keep in mind what I just said previously, though, because if that payment isn't made, someone's making that payment for the borrower. So, this is not, even though the government is encouraging people who can't pay, there is a need out there. There are certainly people out there who, due to the pandemic, they don't have income, right? But not everyone needs to file for forbearance, because if you file for forbearance, those payments will come due at a later date. So for example, if you've got a $1,000 mortgage payment and you miss the next 6 months of mortgage payments, come October, November, you're going to owe $6,000, probably $7,000 plus your current mortgage payment, right? And if you can't pay that at that point in time, they're going to start foreclosing on you. So it's not free money. It's not just something where you can just miss payments and you don't ever have to make them. The lender is going to expect you to get caught up. And for a lot of the people that we, help in South Georgia markets, they're, paycheck to paycheck. They're great people. They pay their bills on time, but they don't have a lot in savings, right? And so if you ask someone, who makes $15, $18, $20 an hour, and they're living paycheck to paycheck, well, now you got to fork over $6,000, $7,000 because you took this forbearance. They're not going to be able to do that. And so there's another category of this forbearance issue as well, is that, it's not going to look good on your credit if you do file for forbearance. So the forbearance is really only for people who absolutely have no other choice, that they have no money coming in due to the pandemic, then file for your forbearance. But just understand, in filing for the forbearance, it's going to hurt your credit. It's going to hinder your ability.
Right? It'd be treated like a late fee, basically.
Correct. Yeah, I mean, and they will technically be late, and so it's a big problem. So the government doing things that are trying to help, but oftentimes what we see is there's bystanders, if you will. There's things that unintentional consequences of some of our actions that we take. It will help the people that need the help, but it's also going to hurt those same people.
Yeah. Wow. And if it were me, and I were struggling, I would think that I would, out of all the things that I had to pay, I would try the hardest to make my house payment.
Well, the housing payment should be your number one priority. You know, but let's face it, we're in tough times right now. I mean, businesses are closed. A lot of people are getting laid off or not getting their full income. So there is a need for this, but under, you know, if you're still able to work, but things are tight, you're able to make your mortgage payment, you need to try to make it if you can at all costs, because filing for that forbearance is going to hurt your credit in a very derogatory way. And it's going to make it very difficult for you to refinance down the road. And believe it or not, as difficult as things are right now, rates are really good. But as we come out of this pandemic thing, along with many other industry professionals, really do feel like we're going to see super low interest rates, even lower than what they are now.
Do you have any idea when we may see that day?
Well, that's a great question. I was on a conference call with somebody higher up today, just this morning before I hopped on this with you, and they're kind of thinking, no one knows for sure because we don't know, you know, when this pandemic is going to be over and done with. But a lot of people are looking at, hey, you know, there's some markets right now where we think we're at the curve or we're curving back down. And to answer your question, most people think that this market will begin to stabilize sometime in the month of June or July.
Wonderful.
So we've got, you know, hopefully it doesn't take that long. You know, hopefully, you know, we come up with a vaccine or a medication that where people aren't dying as much, right? Or, you know, the weather will have an impact on this as well as we enter into the summer months. You know, the heat and whatnot, from what I understand, will have some sort of bearing on this pandemic situation as well. But I would say June or July, you know, the next couple of months here, like I said, I mean, for April and May, if you don't have good credit, it's going to be tough. Yeah. If you do have good credit, no problems. It's business as usual, and you're going to get a great rate.
So you're saying that when the rate market starts to come back and interest rates drop again, that you're expecting these banks to lower the credit score requirements back down?
Yeah, absolutely. Because banks have to make loans to make money, right? Yeah. So what they're doing right now is they're being very cautious because they don't want to make loans and then have those loans go bad. But at the end of the day, they have to loan money to make money. And so as soon as we start coming out of this pandemic, here's the other thing too. You know, I would suspect that you have to understand that the housing market, the housing sector in our economy is a huge, it's a huge sector, which has the ability to prop up our economy on its own pretty much. Right. And as you know, our president's very driven on, the economy, things got to be moving well. And if you listen to him talk in any of his speeches, he'll always preface this national disaster with, well, before this, our economy was at record levels. The stock market was at record levels. We have this engine really running. And all of that's absolutely true. And so coming out of this pandemic, I do expect the market to roar back just probably the way it was and or stronger. Yeah. If you look at the market right now, interest rates should hypothetically be lower than what they are today. Right. The only reason that they're not is because these lenders, again, are being extremely conservative and, they're going to make profitable loans, especially in a time like this. So rates should technically be lower than what they are now. When we have a normal operating market come June or July or August or whenever that occurs, I really do expect rates to level back down to where they should be, which will be at historical lows again.
So what if so let's talk, there's several different scenarios I want to talk about. So what if you are already pre-approved? You've got the credit score. Are you saying that maybe someone should wait to buy? I mean, how do you answer that question?
I don't think anyone should ever wait to buy. I mean, we're not talking about, let's say you got a conventional buyer, I mean, 30-year fixed, 20% down. I mean, they're going to get a rate in the low threes. Okay. So rates for those particular buyers are really super low. And you also have to think like on a conventional loan right now, because a lot of the banks, they're not wanting to lend on the government stuff, the FHA, the VA, the USDA. So they've already got super low aggressive pricing on the conventional loans because they want to make those kinds of loans. Okay. So I don't ever recommend that people wait, especially in a market right now, because things are literally changing so quickly. Like every day there's a new change, right? There are benefits to doing stuff now, such as the appraisal waivers. You're getting a lot of appraisal waivers due to the pandemic, where a lot of the, you're doing desktop only stuff, you're doing drive-by stuff. Sometimes, more times than not, you're even getting an appraisal waiver where you don't get an appraisal at all. That's a savings of $500 or $600 for the buyer right there out of the gate. So I don't ever recommend waiting, because waiting oftentimes can lead to market changes, whereas, because I mean, you and I, Leslie, we have buyers right now that were pre-qualified, that we've pre-qualified, that may not be able to get a house right now because of the credit score requirements and how they have changed.
So basically they were pre-qualified, but now they may not be
correct. So if you're watching this and you have been pre-qualified by us or someone else, it's really important that you are in close communication with your lender to determine, hey, am I still in fact pre-qualified? Are we still good to go on this, or what is the situation?
Yeah. So that's really good information. So have you seen anybody get to the closing table and they're not being able to, the loan not being able to go through? I've heard of horror stories like that.
Yeah, we don't have that a whole lot ever really at our office. I mean, we've got really good relationships with the banks that we sell our mortgages to. They don't really do us on the down and dirty like that. There are I have seen some changes in terms of overlays, is what we call them in the industry, such as, you have credit score requirements that are changing, that are moving up, but you also have some other overlays which are negatively impacting some of the people that we have pre-qualified or who are already under contract, such as debt ratio. So your debt ratio looks at how much money you make compared to how much money you spend. So those ratios have also tightened. And so there have been several instances where I might have to go back to one of our clients who have already been approved through underwriting and say, hey, due to this new guideline or overlay, we've got to work your debt ratio down. So that can be a matter of, just paying a debt off, or changing homeowners insurance, or just massaging the loan a little bit to get that loan to fit into the new parameters. We haven't had anyone's loan not close because of those. We've been pretty fortunate, and we're pretty good at massaging numbers and making people fit into what's required. But and there too are also some exceptions from time to time. So like for us, we do a significant amount of volume. So I leverage that volume with our lending partners, and I can tell them, look, hey, I got 45 loans with you guys, and this one's below a 660 score, but they've already been approved. So I just need you to go ahead and close that for me. And they'll do that because of the relationship that we have with them, but not everyone has that.
Okay. So what if we've got somebody that has a 600 right now, right? And they know they want to buy, and they've not started working with you yet. Should they still go ahead and start working with you and open up a file? I mean, how?
I mean, that's a great question, Leslie. And yeah, I mean, I definitely think that they should. So what Christian and I are doing over the next couple of months while these overlays are in place is, we're still accepting all of our applications. We're running the credit. We're setting deals up. But this is a really good opportunity for those applicants who have lower credit scores to go ahead and get an application with us. Because what we can do now that we know that we're going to have, a 60 to 90 day delay here, is we can really help those people improve their scores over the next couple of months. And, even if you, in a normal market without these overlays, if you came to us and you had a 600 score and we were able to get you pre-qualified, the fact of the matter is you're going to get a good rate, but you're not going to get the best rates out there, right? And so my team, we want you to get the best rates out there that you can. And so it's not a bad thing right now that if you're above that 600 mark, but you're below, 660 or 680, that you go ahead and let us look at your stuff, because there's a great chance that we can make some fine-tune adjustments now that will put you in a much better position when these overlays are lifted, or we can get you in a position where, you're going to get a much lower rate, or maybe even get you into a better loan altogether. And so these are important times right now where working with a good professional can really make all the difference. Because the other thing too is, we talk to a lot of clients. I mean, we probably take 15 to 25 applications every single day. Wow. We want to help everyone, right? But sometimes, it's one of those things where we never tell people that we can't help them, right? Wow. Sometimes people apply at, a big bank or, whoever, and they're just said, hey, we're real sorry, your scores are too low, and we flat out, we can't help you. Yeah. And that's just very discouraging for somebody like myself, because I want to help you. And it's discouraging for the referral partner like you, Leslie, because a lot of these people are good people, and that they could be buyers if they were given the right resources and given the right direction. And I can't tell you how many times that we've taken somebody or worked with them for 6, 7, 9 months, a year in some cases, and they come to us and they were not buyers. I mean, they could not qualify, but over the time they've worked with us hand in hand, and we've got them to the point where now they can buy a home. Yeah. And those are the most rewarding people that we work with.
There's nothing home ownership, helping somebody realize that dream, especially first-time home buyers. I work with so many. They're the most thankful people I've ever seen. I've had clients here recently that were first-time home buyers and, really don't have a clue about buying. And some of them have worked with you and just so thankful. So it definitely is rewarding. Well, that's awesome. What I'm excited about is that everything, to hear you say it sounds real positive. Obviously, the credit score requirements have changed, so it might be a little difficult for people that need to buy a house, but their credit score isn't high enough. But to those people, basically, we're saying just wait. But be patient.
Yeah. So what we're doing in our office is we're like I said, we're accepting applications. We're getting these guys, kind of teed up and prepared. We're going to give them some credit guidance along the way. And Chris and I are kind of starting a list. Okay. So these are all the people that have applied that could normally otherwise be pre-approved and qualify right away. But because of the abnormal market that we're in, they can't. So as these credit score requirements start peeling back and some of the restrictions start peeling back, we'll have a good working list of people we can follow up with and call right away and be like, hey, you're good to go now. So
let me tell y'all, if you're watching, why you need to get pre-approved, because especially if you're a first-time home buyer, houses in that first-time home buyer price range, which are really, I would say, are 150 to 225. That's really high. Mostly it's going to be around that 175 mark, right? Yep. If you're in that price range, those houses are few and far between. That's why we have the lowest inventory. Even right now, we've got a low inventory. So when the market comes back strong, and we're believing it's going to be just as strong, if not stronger, then those people who have pre-approval letters are going to be first in line. Right, Dave?
It's exactly right. And I mean, you hit the nail on the head too, Leslie. I talked to, we love the South Georgia market because those, like you were talking earlier about the first-time home buyers. I mean, our experience in dealing from anywhere from Valdosta to Tifton to Albany. I mean, these people, great folks. They work hard. A lot of them have young families who have been renting for years, and they just want a home of their own. Yeah. And these are the most rewarding kinds of people that we work with. We enjoy working with them and their families. But yes, I mean, I can't tell you how many times that we've pre-qualified someone, and in Thomasville specifically, more so than probably the surrounding cities. Thomasville it's a great town. It's a great city, and the real estate prices support that. Even back during the housing crisis many, many years ago. I mean, heck, that was 7, 8, 9, 10 years ago. I can still remember all of the surrounding cities getting hit very, very hardly in home values, but Thomasville was like the shining star.
Yeah.
I mean, they did not lose a significant amount of home values like some of the other surrounding cities did. Now, with that being said, if you're a first-time home buyer and you're looking in a price range of, 120 to 175, or even under 200,000 in Thomas County, you got to bring it. You got to be ready. You got to have your pre-qualification letter in hand, and you got to get ready. I mean, if you're out working with Leslie, and she shows you a house, and you'll know when you walk into the home that you want to buy. I mean, you just know, right? And when you get that feeling, be prepared to write an offer right away.
Yeah.
Because if you don't, someone's coming in right behind you, and they will, right? So it's just very difficult, that price range in Thomas County. And I can't tell you how many times I've pre-qualified just wonderful, terrific people, and they cannot win a contract because they keep getting beat to the punch by everyone else.
I hate it. So, and that's the main thing. This is a lot of information, especially for somebody that's brand new.
Mhm.
But I want to reiterate what Dave said, and that is make sure you are working with a professional. That means a lender that has experience, or, we've got some great local banks here too. Dave, actually, your main office is where, Dave?
My main office is up in 𝒄𝒓𝒂𝒑𝒑𝒆🏑, Georgia, which is about 40 minutes north of Atlanta. But we have an office on East Jackson Street in Thomasville as well, down from, what is that place everyone like? Jonas, is that it?
Yeah. If you know where Jonas is, you can find his office. Yeah,
so I'm right down the road from Jonas. I work in the 𝒄𝒓𝒂𝒑𝒑𝒆🏑 office. We have an associate, Ken Forrester. He works in the Thomasville office exclusively. But all of us, we all kind of work as a team, so we can all help you and assist you in whatever you need.
Yeah, and it really, I mean, Dave and I, or whatever lender I'm working with, we work together. So it's kind of like you come to me, I reroute you back to a lender, because we can't do anything without that piece of paper or that approval. And then Dave sends you back to me, and we work together throughout the whole process, and we make it seamless. Basically, you just have to do. You wait for us to tell you what to do next, and it's really, really easy.
Unfortunately, Leslie gets the fun part, so she brings the fun. My side of it's not as fun, but we work well together. So definitely, but whoever you're working with, just make sure you got to be careful with some of the quickens. You got to be careful with out-of-state people that you find online, because every state is uniquely different in how they handle their real estate transactions. And Quicken is probably our number one referral source, even more than realtors, because they oftentimes get it wrong, and then we got to pick up the pieces and fix it. So just be real careful with who you're working with. You'll know right away. Well, you should know right away by talking to somebody if they are competent and they know what they're talking about. I oftentimes will tell my referral partners, like, hey, just have your borrowers call us, because they're going to know right away. We're going to take care of them. And I can't tell you how many emails I get every day of people, thanking us, or because, you buy a house, especially your first one, like, you're super nervous about it. Right. And I get emails all the time with, hey, Dave, is this document going to work? Like, I'm just really nervous. This is going to fall apart. And I'm like, type them right back. Like, hey, don't worry. We got your back. And we do have your back every time.
Awesome. Well, this is a lot of good information. I appreciate you so much, Dave, coming on here today. I'm going to tag Dave in this post. And so if you have any questions, you can put them in the comments. But his contact information will also be there. If you want to shoot him an email or call his office, I'll have all of that there for you guys. And so everybody, if you're thinking of buying, just take heart. Still a good time to buy. Interest rates are still low. And we've got some months ahead of us with some great opportunity. So awesome. Well, thank you so much, Dave, again for being here. I appreciate you. Thank you guys for watching, and y'all have a great week.
Thanks, Leslie. Bye-bye.
Thanks, Dave. See you soon. Bye-bye.